Joining us now is Seix Investment Advisors CIO, Jim Keegan. Jim, good to see you. You've had good returns. Now, part of that, of course, has to do with U.S. Treasuries. Do you expect U.S. Treasuries to continue to perform as strongly as they have?
Well, we expect Treasury rates to stay low for longer, and that's driven by what we're in right now. We had a multi-decade debt supercycle that ended in 2007, culminated in a massive credit and housing bubble. That popped in 2007, and now we're dealing with the deleveraging, which started in 2008, but deleveraging cycles tend to take 7 to 10 years. So we're in the early stages of a lengthy deleveraging process, and in that environment, you're going to have sub-trend growth. You've got demand for income with the Fed keeping rates here anchored at zero. They're pushing people out along the yield curve. Income is more important when you have zero rates, so you go into corporate bonds, treasuries, mortgage-backed securities, and then the demographic wave. We've got 78 million baby boomers that are going to be retiring over the course of the next 18 years, and they have inadequate savings. So demand for income over growth seems to us to keep yields anchored down here at very low levels for a lot longer than the market has been expecting.
Does that make it safe to go into longer duration instruments as well?
Well, yeah. I mean, I think longer duration instruments is where you're getting the yield. And in this environment, where we have a lot of debt that needs to be worked off, and the deleveraging process is going to keep a lid on rates. And then you take the low yields, not only here, but in the stronger economies around the world, where you see this flight to quality, given what's going on in Europe. First, it started here with our banks. Now it's their banks. It's their sovereigns. There's demand for safety, and treasuries are still deemed safe.
Okay, sovereigns, safe sovereigns. So where are they at this point?
Well, I mean, if you look at Northern Europe, you've got, the countries that have low yields are the United States, the UK, Germany, the Netherlands, some of the Scandinavian countries. They're deemed to be the safer sovereigns at this point. Now,
what about through Asia? We've had a number of guests on who've talked about Asia in some ways being a safe haven right now.
Well, Japan has obviously been in a lost decade now for 2 decades. And the interesting thing is that the United States has been in somewhat of a lost decade if you look at jobs, real median household income, stock prices, and now housing prices. We've already had a lost decade ourselves. The question is, what are the policy responses going to be going forward so that we don't have a second lost decade?
Now, a lot of investors, by looking at market movements from day to day, seem confused by what is happening right now. And we've even seen that in the bond market, right? We've seen Pimco sort of changing their strategy from the beginning of the year to the end, saying that now they are buyers of U.S. Treasuries. How do you explain that type of change in behavior? You've been very consistent.
Yeah, well, we've had an overweight in corporate bonds and mortgage-backed securities, the so-called spread sectors. We've had a minor underweight in treasuries. So really the return this year hasn't necessarily come just from treasuries. Treasuries have been the best performing sector in the bond market, but really what's underperformed here are the risky assets, and in the investment grade space, it's been financials. And there's a lot of investors that are trapped now in what I call a too big to fail trade. They're in bank bonds, they're in U.S. bank bonds, European bank bonds. They're in some sovereign credits over in Europe. And the liquidity is so poor right now that they're effectively trapped in what I call a too big to fail trade. So by definition, they've had to go into treasuries and agency mortgage backs to hedge the too big to fail risk at the other side of their portfolio. Right.
They've had to get out of those trades now. But do you think that means that there's an opportunity at some point in those too big to fail trades?
We think it's early. We think it's very early. And again, you got to ask yourself, if you're managing a bond fund, are you supposed to be speculating on bailouts and political decisions? And that's effectively what a too big to fail trade is all about, that you're going to get bailed out if the institution comes under pressure and potentially is going to fail.
All right. Thus far, that remains to be seen. Thank you so much for joining us, Jim. We got to leave it there. That was Jim Keegan, Chief Investment Officer of Seix Investment Advisors. We're going to